thank you all for coming. We really appreciate the range of investors and corporates that we've got here today. For our first session, we have had a couple of changes to the speaker lineup. It wouldn't be a live event if we didn't have some kind of movement. But I'm pleased to say that we do have Tricoli of Denham Capital here, Caroline Donnelly of Sprott Resource Streaming and Royalty here, and Kevin Smith of Crescat, who stepped in kindly to beef out the panel as we had a couple of speaker dropouts, as I said. Kevin was originally speaking tomorrow as well. So I'd like to welcome my panelists to the stage, and we're going to be tackling some of the headline themes that are really steps over this way. Quite a steep entry for this one. We're going to be tackling some of the headline themes that are really shaping the mining industry at the moment. Where to start? There's so much going on in the world at the moment on the macro, and there's so much going on within our sector. It's certainly an exciting time. If you have a question, raise a hand. We'll try and get it out to our panelists, and we'll go from there. So thanks very much for joining me, everyone, and welcome. So sanctions on Russia, the war in Ukraine, an already hot commodity market. I think when we've done some of these discussions virtually over the last year, we were talking about how good the sort of market was for metals prices, how things were heating up. On top of that, Jose, welcome. Glad you could make it, please. This is Jose Martinez from Rimac, Segurios, his CIO as well. Biographies of everyone are in the brochures. I'm very pleased you could make it. Thank you. So we're now 4. Excellent. So yeah, just framing this. Are we entering a super cycle? Is there a fix for this energy crisis that we're facing? Caroline, take us through some of your interpretations from Sprott on this macro picture.
Well, thank you, Adam. So good morning, everyone. I'm Caroline Donnelly. I co-manage the Sprott Streaming and Royalty Fund. So I'm going to talk about, all my perspectives will be from the perspective of our fund, which is streams and royalties, and not the broader Sprott as you would typically see, and certainly not from Eric Sprott's perspective. So bear that in mind, as I speak, that I'm talking my own book about streams and royalties. And for us being investors into the sector and looking at things from the streaming and royalty perspective, we take a very long-term view. So we're looking at companies and transactions that can run 10, 15 years quite easily. And obviously there's short-term spikes and short-term dips. I think from a longer-term perspective, we expect this to be reasonably short-term in that, probably 3 to 5 years. And after that, expect something completely different. When we're pricing our deals, we are looking certainly at higher prices these days. We've seen all the commodities run, as you mentioned. I think what we haven't seen is the equity prices of the juniors run as one would expect. We haven't seen the trading liquidity, we haven't seen investors coming back into the market. So notwithstanding sanctions, wars, everything else which is going on, we're just not seeing that translating. And I think that makes it a challenging situation.
Do you think things like the copper going to all-time highs, the LME nickel market busting, these incentive prices that are going to let people start thinking, hey, I do need to invest in a nickel junior or a copper junior, and that in turn is going to kick the equities on?
I'm not necessarily sure that it's the pricing. So we, within our fund, and it's public knowledge, we have a portion of an investment in Highcroft Mining, who you've probably all seen recently had AMC come in as an equity investor. And that has been a fascinating ride over the last couple of weeks of just watching the liquidity change for that stock by bringing in, admittedly, short-term money, but the generalists who are, rapidly trading, and that company's turned over twice its available shares, twice its available float in a day. So, I think there's different forces at work in order to try and get people into the sector. And, frankly, if you can get AMC and the Reddit crowd in, that makes a massive difference.
Absolutely. Excellent. Okay, we can delve into some of those points in a little bit more. But Carl, please introduce yourself. How's the view from Denham right now?
Great, thank you. I'm Carl Tricoli with Denham Capital. We are a private equity provider to the mining space and the firm as well invests in the power sector, renewables, and oil and gas. So to try and unpack this, there's a number of different things that are going on right now that probably result in some structural changes. So to answer your specific question, are we in a bull market or another super cycle? I think the answer to that is yes, based on a few fundamentals, some more permanent than others. So obviously, and everyone in this audience is familiar with this, there's been incredible underinvestment over the last 10 years. And so there's not a lot of money that has gone into sort of prepping for the need for additional supply that comes from the energy transition and some other things. So that's just something that sort of sets this up for sort of stronger prices. And then there are these sort of temporary things, we hope temporary, of what's going on in Russia, for example, that sort of just mixes things up a bit. And I think there are two things that come out of that. The first, there are a couple of commodities in which Russia is pretty dominant. So potash, for example, met coal, they're number 2 in met coal. Russia and Belarus together are number 1 in potash. There are several others. So that causes just some short-term disruptions until that situation gets resolved. I think the more permanent aspect of that is people are going to think very hard about what their supply chains are, and I think that's what impacts that on a longer term basis. I will echo what Caroline said. What we're seeing is that, interestingly, the public markets don't seem to be responding very much to this whole energy transition theme in terms of raw materials, and so much of the capital is actually coming from folks like Caroline and myself on the private side. And then the other thing that we are beginning to see as a capital source are actually end users who are trying to tie up their supply chains. And so we have actually, interestingly, had inbound interest from auto manufacturers and other end users in terms of investing in our projects because they want to secure their supply chains. And so when we look at development capital, again, that's coming from primarily folks like Sprott and Denham who are putting money into projects, and you're not seeing the money coming out of the public market. And so you sort of put all that in the pot, and I think that sort of sets up the world for a pretty constructive commodity environment over the next 5 to 10 years for sure.
Fantastic. And do you share the same sort of view that things are going to cool somewhat in sort of 3 years, or prices are going to cool in that respect?
I'm probably a little. I think that this sets up more for a sort of 5-year plus scenario. It could be even longer than that.
Yeah.
Part of the issue we're facing now is that's great that prices are up and our revenue side is up, but what that's also doing is lifting up the cost side of the equation. And I would say one of the biggest challenges that the mining industry as a whole is going to face that lifts those prices up is actually just people. I mean, we are having an extraordinarily difficult time finding the talent that we need to actually bring these mines into production. I mean, you sort of had an entire generation that's sort of retiring, and nobody went to school, frankly, to with the intent of getting in the mining business. They all want to do, actually what they all want to do is TikTok videos.
Tech related stuff.
And so that's a challenge. And so again, I think this whole thing just sets up for, I think, what is a longer term structural, sort of super cycle.
Excellent. Interesting. Yeah, you mentioned the word. Kevin, what's your take on this macro? And also please introduce Crescat and your funds.
All right. Thank you, Adam. So Crescat is first and foremost a global macro hedge fund. And we, one of our major macro themes over the past few years that has evolved is really this the inflation trade today, and the underinvestment in natural resources plays a lot into that, in the energy space especially. But there's really 3 main macro forces that we see that are setting up the opportunity today for a long-term secular bull market in precious metals, in base metals, and in the mining industry, and that is number one, the overwhelming global debt to GDP problem that we have. And I mean, for years, we've been concerned that this is ultimately going to lead to inflation. And it hasn't until now. Now we really do have inflation. The money printing is leading to inflation, and the central banks are trapped, really. And I can get into that more. But the second major thing that plays into this is the overvaluation of what we call long duration financial assets. So tech stocks, fixed income investments, in general, mega cap tech, software stocks. You've started to see a little bit of this rotation out of these overvalued tech names into undervalued commodities in the last several months, in the last year, really. And we think it's only the beginning. And then so those are the first two, and then there's the I'll get he just called me on here on short notice. But the third one, so it's the overvaluation. It's the underinvestment really in commodities that we've seen is really the third major factor. And this has been in the precious metals industry. This has been really a 10-year theme. It was of underinvestment. It was really 2011 when the mining companies were spending like drunken sailors on new projects. But that was the end of a 10-year bull market for mining stocks. And since then, the majors have really been hesitant to invest in new projects, in exploration, in CapEx for new mines. And so we think there's an M&A cycle that's coming. What we decided to do to exploit the opportunity is really to focus more on the exploration side of the industry today, because that's where the new deposits really are going to come from for energy transition or battery metals or precious metals. It's the exploration segment of the market today that really we think has the most opportunity, and so that's where we're focused at Crescat. We own about 75 different companies in the exploration segment. We got primary gold plays, primary silver plays, and some copper, some nickel, and that's how we're looking to exploit this kind of left-hand side of the Lassonde curve, where most of the wealth is created in the industry, and that's the opportunity today. We do think it's a long-term trend, at least 3 years.
Yep, excellent. Okay, and just on one of your points there around the inflation, the debt to GDP ratio, are we in sort of recessionary territory here? Just to sort of conclude on the macro, is that?
Well, a lot of the news has been, with the interest rates have that people have been talking about. The yield curves are starting to invert, and this is certainly an early signal of a potential recession. And we think the Fed and most central banks are trapped. They can't raise interest rates high enough to fight inflation without also causing a demand slowdown. But demand, slowing down demand is not going to stop the underlying supply crunch shortages that we have for natural resources. And you can't raise interest rates, 250 basis points and really do anything to improve that imbalance. And so, this is, we think it's a lot like the early 70s, the setup today, like a 73, 74 kind of a market, where you can see rising commodity prices, rising inflation at the same time as you see stock market correction. And that 73, 74 recession was brutal. And yet this is the type of environment I think we're going into today that can be bullish for this industry and cause a recession at the same time.
Yeah, excellent stuff. Jose, please, could you introduce yourself and Rimac Segurios, because you're the CIO of but you're also positioning into metals and mining companies, which is fantastic. So just introduce to the audience your position, and then please give us your commentary on some of what the panelists have disclosed so far.
Yes, thank you very much. Thank you for the invitation, and I'm sorry I was a bit late, but yes, I'm Jose Martinez Sanguinetti. I'm the Chief Investment Officer for Rimac, which is Peru's largest insurance company. We invest on a global basis. A great deal of that in fixed income, but we also do alternatives and and stocks on a global basis as well. We have also had for a long time the idea that commodities were the next boom to come, and that has already been happening over the last few years. And I sincerely believe that it's probably going to continue for many more years. And the reason for that is that, I mean, even though the Ukrainian crisis may be transitory, it's going to change the world. And the way it's going to change the world is actually going to add to the trends that already were, supporting the idea that commodities were in a long-term rally. And the reason for that is very simple. I mean, I think the Western world has realized that Pax Americana is not, I mean, on a global basis, is not going to happen. I mean, the world is going to polarize again. And as it polarizes again, I mean, the Western world is likely to form new supply chains that will need infrastructure, and that will need substantial investment to rebuild after the conflict ends. And all that adds to energy transition, which is something that is likely to stay for a long time, because at the end of the day, I mean, the causes for it have nothing to do with geopolitical events. And there's also some trends that I see that are likely to remain. I mean, one of them is the emergence of Asia as, the center for the economic growth around the world. I mean, that's the fact that most of the world's middle class is going to be sitting in an Asian country. I mean, over the next 30 years creates an enormous power for construction, for building, for urbanization, and that creates demand for commodities as well. And that isn't likely to change. I mean, even though the world may polarize, and even though there may be, a balance of powers and will need to be built between the US and China, I mean, Asia is likely to continue growing, and Asia is likely to, I mean, many of the Asian countries, I mean, the large Asian countries are likely to integrate with the Western world in a way. I mean, just like Europe integrated with the United States after the Second World War. So that's also a force that will add to commodities demand in a world where supply is scarce because of underinvestment over the last decade, and because of restrictions on social and environmental restrictions, which are good. I mean, they're something that we must strive for, but definitely rise the costs of production of commodities. So at the end of the day, I think that I mean, whatever we are seeing in the long term is going to be beneficial for commodities. In particular, those that are involved in energy transition, and those that are involved in the supply of food to this rising middle class all over the world. One point that I'd like to add is it is true that developed countries are highly indebted, and that's likely to keep real interest rates low for a long time throughout the world. But emerging markets are not. I mean, emerging markets are entering this phase with really low debt levels. And I mean, if you look at Asian emerging markets, if you look at Latin American markets, which Latin America has its own dynamic and is likely to benefit from the fact that commodity prices are rising. But I mean, there's a lot of political instability that is arising from the pandemic in that part of the world. But at the end of the day, I mean, the fact that those countries have very low debt levels will add to the fact that growth will concentrate in those parts of the world. And even though financial conditions may become less lax in the future as central banks try to deal with inflation in developed countries, I mean, real interest rates are likely to remain low, so that will boost investment throughout the world for some time.
Okay, excellent, fantastic, really good insights on emerging markets as well there. We've powered through a lot of time on the macro. Let's hone in on investing, capital allocation into junior mining companies now. With what we've discussed, Caroline, are you changing your approach at the moment as a streaming and royalties provider? Is the market kind of too hot for new deals at the minute? How are you looking for value?
We've seen the largest streaming and royalty players like really sprinkling their money around at very, very low cost. Almost the same as your residential mortgage, that low cost. And these are on projects which are in some instances not permitted and certainly not yet built, which, to us just seems like a terribly risky proposition, but as it's not my money, good for them, and great for the companies that can get their hands on that money. I think that's fantastic. Where we've seen our niche is we're looking earlier and earlier with companies. So, we're able to fund off the back of a PEA, off the back of a pre-feasibility study to help those companies move forward in a non-dilutive way. And we found that's got a lot of traction. We recently did a pretty small deal for a company in Ontario on using this model. And we've recently done $225 million for Seabridge using the same model. So it's a model which scales well, and as I say, helps companies progress their project to the point where they're then ready for the mortgage style rate money coming from some of the larger companies. So that's what we've been doing, Adam. And to the rest of the audience, we've been going sort of more risky and earlier on in a means, to try and alleviate A, so we can deploy capital, but B, to try and alleviate some of that malaise in the junior mining market that I referred to earlier.
So it's music to the ears of a lot of earlier stage explorers. But fantastic. Carl, how's the private equity approach? Because you're patient capital. What's the current lens that you're looking at companies with?
So our approach is also evolving a bit, and as you try and seek value, and as Caroline has just said, they're looking to do a little bit earlier on in the life cycle of the asset. We are primarily looking at sort of where we actually play in the capital structure, and so what you have right now is sort of a plethora of juniors who have market caps of $25, $30, $40 million, and they have projects that they need $500 million, to $1 billion. And, that's obviously just not going to be raised in the conventional public markets. A traditional approach of us bringing all the equity to the table is a little bit problematic, particularly if you're a public company. And so we are looking at filling in, been in a couple of projects in the last 6 months, of sort of filling that gap with more structured capital, and that's going to be a combination of debt, it's going to be a combination of preferred equity or something like that, and probably have some talent as well. And sort of bringing all that to the table so that you can get these projects built. We're also very, very, very focused on very long life assets, and so we have assets now in our portfolio with mine lives ranging from 80 to 150 years. And so the thought process is, rather in this kind of a price environment where companies need capital, rather than approaching it from a straight equity standpoint, the idea is to do something a bit more structured. And then we're also looking at, as a part of that, creating income streams, because our investor base are all very long-term pension funds, endowments, people, family offices with very long-term perspectives. And so the idea is to make sure we have appropriate return through the structured instrument, but then as a component of that, create a dividend stream that goes on for a very long time. And so our approach to this is more sort of changing the structure of how we actually invest the capital.
Yeah, excellent. Kevin, over to you. Different approach, but take us through Crescat's approach and where you see value. You mentioned before you hold a lot of companies.
Yeah, so we see value in the really in creating, helping to fund and develop the next the next big high grade mines in the world. And oh, excuse me. No, sure, I'll take it. I'm just getting over a cold is all, but I'm on the last legs of it. But so there is a tremendous amount of opportunity because of the underinvestment that's happened over the last 10 years in the whole space. The majors have not been investing in building new mines. The capex has just been down for 10 years, and the exploration segment of the market has been starved for capital as well. So Crescat, we've been trying to change that. We hired one of the foremost experts in exploration geology to come in and help us build this portfolio. His name's Quentin Henney, and he's been responsible for at least a half dozen major gold discoveries himself. He's got 30 years of industry experience. Started his career with Homestake, which became Barrick, and then worked for Newcrest, the largest Australian miner, for Newmont, the first half of his career, and then he spent the last 15 years working for juniors, developing big deposits. He's the one who designed the drill hole at Fosterville that made Eric Sprott over $1 billion. And so he's been helping us to put together this portfolio of yes, we have 75 different companies in the portfolio, and it sounds like a lot, but if you consider the globe and how gold deposits and other silver, copper, whatever it is, are formed, they can happen over just a few square kilometers of ground, and so there's millions of prospective deposits all over the world. There's like 2,000 publicly traded mining companies, and yeah, most of them are juniors, but this is where the opportunity is. This is where the wealth is created. This is where the billionaires, make their money, is on new discovery, whether it's Pierre Lassonde, whether it's Eric Sprott, Robert Friedland, et cetera, et cetera. And so this is what's exciting to us because of this decade of underinvestment. This is also where the value opportunity is. I mean, who would have known that inflation could be above 7-8% and silver would still be trading at $24 an ounce? I mean, it's ridiculous. Silver was $50 an ounce in 1980. It was $50 an ounce again in 2011, and we're at 24 today. Inflation has taken off, so yeah, nickel pops, and uranium is interesting today, and lithium had a run, et cetera, et cetera. Gold and silver are poised to break out of like a multi-decade cup and handle formation if you're a technical analyst. I mean, this is there's a lot of upside ahead. It's inflation is finally here, so we want to focus on exploration. We want to get the money to the companies to do the exploration work, to do the drilling, to build out the next big high grade deposits on the planet. And I don't think it's the Hycrofts of the world. I was invested in Hycroft back in the day when I didn't know anything, and it was it went bankrupt under Allied Nevada. I mean, I don't know, maybe they're going to turn it around this time, but it's not the low grade refractory deposits. It's not the, as Quentin said, it's not the picked over carcasses of the last cycle. It's about getting the money to the companies to make the next big high grade discoveries. That's where we're focused.
Can I throw something out there, just on the point that Caroline was mentioning earlier, that we haven't seen the equities of the juniors really rise yet in sync with what's going on in the metals mining commodity space. That's not so much a concern for you, really, because you're focusing on taking these companies to the next producing mine, right?
Well, we want to stay with the companies through the development stage where it makes sense. In some cases, we're willing to have an exit, during that excitement, during the exploration phase. But I think that there's a lot ahead to the cycle, and I think people are afraid to invest in juniors. And yeah, juniors are in the dumps. They haven't, the stocks have not been. I think gold and GDX and GDXJ even, which is not really a junior. It's more of a developer and producer kind of an ETF. The real juniors, the micro caps and the small caps that are focused on exploration, are not part of GDXJ. and they haven't done anything yet this year. But yeah, they've been underperforming. But as the generalist money starts to come in, I mean, gold has been dead. I mean, people want to buy crypto, but this is early days. It's a long cycle ahead, and there's just a lot of opportunity for the juniors to get some traction here. It's very early days.
Excellent. Okay, good to get that overview. Jose, how do you invest in what type of companies do you like to invest in within the mining sphere?
Well, what we have been doing over the last few years is basically focusing on those minerals and metals that are likely to benefit from the global trends that I mentioned in my first intervention, and we've been doing that mostly in the public markets. And in the public markets, you get a chance to try to time the market, and that's what we have been trying to do. And we've been trying to take advantage of situations where market unrest leads to valuations to correct sharply, and we may be getting close to a situation like that now, as the world sort of, or the markets which have react rather in a rather calm fashion to whatever is going on in Ukraine, actually incorporate the fact that this will have a recession impact on some countries in the world that will spread to the rest of the world in reducing growth rates. And probably, I mean, it may not be the case that the US fall into recession, but I mean, some countries in Europe will. I mean, maybe Germany and definitely Russia, and that will impact. I mean, that will transfer to the rest of the world, particularly if Germany does fall into recession, which is something that is likely. So I mean, we're waiting for that to happen, but we believe that the long term, I mean, the story remains intact, and that there's enormous potential for earnings growth in the mining industry in the future. Not only from the fact that prices will likely remain high. It's also from the fact that the technological advance may lead to cost reduction that will lead to improving earnings in the future. And because I mean, as investment reactivates, it will lead to better margins and better profitability levels in the mining industry. So that's what we're doing in infrastructure, for instance, which is not mining, but it's related to mining. I mean, and what we have been doing is we've been moving that. Then in infrastructure, we invest in private markets, and in private markets, what we have been doing is moving to an earlier stage of projects in order to take advantage of the higher growth potential, and not depending so much on finding out a multiple higher than your entry multiple when you exit, because that may not be the case in a world where valuations seem to be a bit stretched. But I mean, going back to the point that real interest rates are likely to remain very low and maybe negative for a long time. I mean, we're likely to see high valuations for a long time too, in response to that.
Okay. We've got 5 minutes left. I want to open it up to the floor if anyone has any questions for our panel at all. Okay, right down here, please. It's a small room, but we've got a mic if you want one. And then there was a question over here afterwards. I'll ask in a sec. On, guys?
Okay, I mean, usually when you're recording, it's better to have microphone. You talked about I'm addressing to Carl, you talked about the energy transition and the mining implications, and I think I heard the word uranium once. I'm with Nucleation Capital, I'm Rod Adams, and we're very excited about advanced nuclear energy systems and the possibility that very soon they'll start growing and deploying around the world. But as you talk about an underinvestment cycle, I think uranium's been low for about 20 years. Do you see any opportunities in that sector?
Uranium, I'm gonna take that.
So I don't think I mentioned uranium, but uranium is an obvious, nuclear power is just an obvious part of the solution, and when it gets sort of caught in, sort of the same sort of ESG concerns today. Like, for example, met coal. We have a met coal mine that has been extraordinarily difficult to finance, despite the fact that without that met coal, you can't build your wind turbines, you can't build your solar panels. And so, yes, we do think that there is a place for uranium. We have not invested in uranium. I think we have, the issue we've had, frankly, with uranium thus far has been uranium for 20 years has always been poised to sort of break out and go up. And so we haven't seen that yet. We've not sort of seen a uranium project that we've had specific interest in, so it's not a theme for us specifically. Having said that, when sort of you look across the various options that you have as part of the energy transition, it's obviously, one that should be there. It's just so challenging to get people's heads around it from an ESG perspective.
Yeah, please.
Guys.
Are we doing the mics?
Yeah. If I can add in there, I feel like the whole movement in the uranium price has been because of Sprott. So I'm not necessarily sure that it translates into a supply-demand issue. I think it's more my colleagues on the other side of the wall have been out there buying it up for the physical trust. So, I know from our perspective, we too keep looking at uranium projects in order to do streams and royalties. But it's hard to put a pin in where you think the price should be when you have someone on the other side of the wall that's buying it all up.
Interesting. Okay, there was another question down here. There's 2 minutes left.
Just a quick question. I was
Oh,
wondering.
sorry, the gentleman in front of you. There you go, man. I got it. Okay.
Is it on? Yeah. I was just wondering what the panel is thinking about the recent nickel market disruptions.
Okay, then can I stop there? And can we get your question as well? And then I'll run through them.
Yeah, here. Thank you. I got it. So speaking from an individual sophisticated investor standpoint, all right, there's a strong belief that the large investors, endowments, et cetera, really shied away from this whole genre of investing down to about 0.5%. And if they would get up to 1.5%, it's really going to move the needle. I'm curious whether the panelists are on page with that. And then the second follow-up question would be for someone like myself, it's a moderate risk, sophisticated single investor. What is a portfolio allocation? Like right now, I'm at 4% in this genre, but is it 10%, 5%? And please speak openly.
Okay, do you want to do that? Do you want to do that, and then we'll go into nickel? Anyone?
I'll take just a quick stab. I'm not going to address your second question. I'll address the first one. Part of the issues for sort of our limited partners who are endowments and very, very large institutional investors, frankly, in the mining space is, sort of when you go back a little ways, it's just not been very exciting and it doesn't fit in a bucket. And they're all bucket allocators. And so they have an oil and gas bucket, they have an infrastructure, you sort of go into private markets. And then there's real assets, and in real assets, you have real estate, you've got energy, and mining was sort of like this orphan. And so, this last fund we raised, we spent, half of our time explaining why you should be invested in mining, much less why you should be investing in Denham. And so there's just been a level of, just the knowledge has not been there. That is beginning to change as people are now just beginning to focus on the supply chain issues with the energy transition. So now we're actually getting some inbound calls of people essentially saying, we don't know anything about mining. Can you talk to us about mining? That's balanced out with, but oh my God, these ESG issues. And so the challenge for all of us is that we have to connect all the dots for them of why raw materials are going to be so incredibly important for this energy transition, and why actually the industry as a whole, when you think about the transformation as it goes into some of these, more challenging jurisdictions in the world, are actually significantly improving what's going on in ESG. And there's actually a great story there. And so to your question, yeah, if you move from 0.5% to 1.5%, that would be pretty needle moving for the private markets, because frankly, it's a drop in the bucket in terms of private markets for what is actually going into the mining sector. But based on sort of inbounds and interest, we anticipate that increasing kind of over the next 2 or 3 years. All right, Caroline, from your experience.
We just recently closed our fundraising, and there's a press announcement out there. We found that the endowments and foundations have no interest in mining whatsoever. They don't want to have to deal with, their students or, whoever else it is that they have to talk to about mining, specifically for the ESG concerns. They don't care about the fact that there's electric vehicles. They don't care about energy transition. They just have zero interest. It's just too hard. It's too hard for them. The pension plans, however, the state-run pension plans are on the other side of the spectrum. And they've all moved away from oil and gas because, both Carl and I live in Houston, and oil and gas it's almost considered legacy these days. I mean, how we're all going to drive, et cetera, is another story entirely, and not one we're going to get into. Yeah, yes. But the pension plans are very keen on mining. And I think it also depends where you are in the capital structure. So, Sprott runs both a lending fund and then our streaming and royalty fund that I'm part of. And those two buckets are, lending is obviously a credit buckets. So that's, that doesn't suffer the challenges that Carl mentioned about being bucket allocators. And on the streaming side, we found that they literally just view us as commodities exposure first and foremost. And, it almost fits within oil and gas. So it's the same people who are looking at oil and gas, who are looking at mining, who have an understanding of the cyclical nature. So I think the investors on the private side are bifurcated between whether it's endowments and foundations who are a big no, pension plans who are a yes, and then are you higher in the capital structure or are you, more equity focused?
Very good. 3 minutes left. Does anyone want to hit the nickel question as well? Electric vehicle battery manufacturers?
Well, I mean, the most immediate obvious issue with nickel is the disruption in Russia, who is a significant supplier to the nickel markets. I think an interesting thing to come out of this is what happened on the LME that shut down trading and voided a number of trades. That is having some ripple effects in terms of people thinking, uh-oh, I always thought at least what was dependable was a market that, I could execute my trade. And that is causing a little bit of uncertainty just in terms of the broader market. And in terms of nickel generally, that has been, at least recently, more trader driven based on what's going on in Russia than it's been sort of more fundamental supply demand driven. And so how that plays out somewhat depends on how the situation in Russia is resolved.
Any further comments on that? We've got 2 minutes left.
I would just say on the question of investment allocation, I agree that the institutional investors are underallocated. I think there's going to be a generalist wave that captures the institutional as well as the retail investor into the space. And, we're more tactically focused at Crescat, where we, we see this overriding great rotation theme coming where people are going to be taking money out of overvalued financial assets in general, long duration financial assets, and putting it more into undervalued inflation hedge assets. And I think people are underinvested to natural resources, to commodities, whether it's energy, materials, whether it's institutions, retail investors. Everyone's long the mega cap growth, the FANG stocks, software. These these sectors are going to start to come under pressure. So if you're an aggressive, you have to have your own strategic or tactical allocation, and you got to decide where you want to be. But I think person's going to need a lot more than a few percent exposure to commodity industries if they want to perform in the coming environment. Look at 1973, 74. Look at the early 2000s when you have bubbles in financial assets and rising commodity markets. You want to increase your allocation tactically, I think, to those markets.
Excellent. Well, look, we're fresh out of time now. Let's have a round of applause for our panel. Thank you.